Good afternoon, everyone. My name is Jonathan Levin. I'm a columnist with Bloomberg Opinion. I'm here with Greg Dacko, chief economist with EY. His priors are Oxford Economics and IHS Markit. Great follow on social media. Also here with us is my colleague Allison Schrager, senior fellow at the Manhattan Institute, Bloomberg Opinion columnist and author of An Economist Walks into a Brothel and Other Unexpected Places to Understand Risk. We're here this Wednesday afternoon for Fed Day, of course. And the Fed is widely expected to hold rates at a range of 4.25 to 4.5%. But everyone's attention will be on how Fed Chair Jerome Powell is interpreting the outlook, both for policy and the underlying economic data. Will he give us any clues about how he and his colleagues might react to tariffs? Does he still think that interest rates are restrictive, so to speak? And will he leave the door open to additional cuts later in the year? Greg, let's go straight to you. It seems like the White House is getting all the attention these days in market and economic circles. What could we learn today that could, shift the narrative, if anything?
Yeah, I don't think we're going to learn much from the statement. As we were just discussing, I think this is going to be a boring start to a tumultuous year because we're not going to get much change in the statement, still noting that we see a slowdown in inflation, that the labor market momentum has softened a little, and that the extent and timing of future rate cuts or rate changes actually will be determined by economic data. That's likely to stay in place. It's going to be interesting is to see how Powell frames the discussion in terms of how restrictive policymakers believe monetary policy still is. We've seen an upward move in the estimates of the neutral rate. So how much monetary policy restriction do we still have today? And how much further easing is expected over the coming months to get to neutral? And then the second element that will be quite important during the press conference is how policymakers are interpreting the upside risk or downside risks to inflation, to growth from the policy mix that the White House will be unfolding over the coming months. Trade policy, tax policy, regulation, immigration policy. How will those influence the landscape?
Yeah, there, Allison, you know very well. There's a performative element to this this job of Fed chair. How do you think Fed Chair Jerome Powell should navigate all the uncertainty here? The things that Greg's just mentioned. What is the right way to deliver this performance?
He should be as vague as possible.
How should you do that, Allison?
We're just going to hold. We're going to wait and see. We anticipate more easing later in the year. We'll probably be back to our target in another year or two. All of this. Because what he's not going to say, which is what he probably really thinks is, we might just be at 2.5%, 3% inflation. And rates aren't that restrictive, aren't having the restrictive effect we think. So maybe our tools don't work anyhow. He's not going to say that. But that might be true.
Okay. We know that some people are thinking that out there. And as you and I have talked about a lot, Allison, in this New York Fed survey of primary dealers that I follow very closely, certainly, the average estimate of long-term neutral has been drifting up, but it's been drifting up in very, very small increments. Greg, for your part, how are you thinking about that? Do you personally think that we're restrictive here?
I think we're still restrictive, but I think there is a misunderstanding as to what the long-term neutral estimate is versus the short-term neutral. I think the long-term neutral is a steady state where the economy is growing at its potential, where you have essentially the economy being driven by supply-side factors. I think that's not too far from 3%. I wouldn't be too surprised that it's somewhere around there. It's a guesstimate anyhow. The short-term neutral, I think, is higher.
Sorry, is that 3% real or nominal?
In nominal terms. So 1% in real terms, if you assume that inflation is going to be trending at 2%, which is another open question that we could argue about. But the short-term neutral, I think, is somewhere higher because we've seen less of a constraint on economic activity despite the Fed funds rate having been at 5.5% as recently as 6 months ago. So that, I think, is probably higher. And I think the inflation target, in my opinion, is too much of a focused, bullseye type of target, and there should be more flexibility around that target.
Yeah, well, here we go with the decision. I've got the yield on the 2-year Treasury note up here, so you can see how that reacts as the figures come in. And so the Fed holds the benchmark rate at 4.25 to 4.5%. Some headlines that are crossing over at our Bloomberg blog says Fed removes reference to inflation making progress toward goal. Okay, that's noteworthy. The Fed, unemployment stabilized, labor market remains solid. Off of the back of these headlines, we do see the yield on that 2-year Treasury note stepping up a little bit. We never totally trust these knee-jerk reactions. I'm going to do uh, a little exercise here and put up this statement, but this is going to be the version of the statement that shows folks exactly what has changed from last time. Now, this can be a little bit difficult to read on the screen here, but I'm going to hopefully help folks interpret this a little bit. So here again are the changes. Let me actually make that a little bit smaller so that folks can hopefully follow along. Okay, so we have some changes in the first paragraph of the statement. It now says recent indicators suggest that economic activity has continued to expand at a solid pace. The unemployment rate has stabilized at a low level. Okay, so that's new language, that the unemployment has stabilized. Recall that the unemployment rate had been drifting up for a little while, but the most recent reading at 4.1% basically shows it settling in at this very low level. And this is a new addition, labor market conditions remain solid. And then this is going to be the other key bit here. This is the bottom of the first paragraph. It now says inflation remains somewhat elevated. So you're changing the language from inflation has made progress toward the committee's 2% objective, but remains somewhat elevated. And it's now just saying inflation remains somewhat elevated. And I think what we're really talking about here, Greg, maybe you'll disagree. I think what we're really talking about here is these key year-on-year figures in core PCE. And to another extent, headline PCE. They've kind of been hovering around the same levels for a little while now. Some of us might say that a lot of that is base effects, but the numbers are what they are. The committee's interpretation, or at least the interpretation that they want us to take away, is that inflation remains somewhat elevated and we're not trending in a better direction. What do you take away from that? And do you agree with them?
Yeah, I think that's really the most important part in this report. It's a hawkish statement, a little bit less boring than I was anticipating, because they do two things here. They highlight the fact that labor market conditions remain solid, and they're not talking about any easing anymore. And two, on the inflation front, they're not talking about the fact that inflation is continuing to evolve towards their target, but instead has stabilized. In my opinion, and I've written about this in the past, they are over extrapolating data reports. They are over extrapolating reports that indicate that either inflation is hotter than expected or cooler than expected. I wrote a note a couple of weeks ago about the fact that I called it, oops, they did it again. They got caught in the game of paying too close attention to any single data report and over extrapolate to infinity. And that is very risky. They've done that again and again, where anytime inflation comes in hotter than expected, they anticipate that the forecast over the next 12 months is going to be higher. And whenever inflation surprises on the downside, they over extrapolate for the next 12 months. And their economic projections reflect that, going from one side all the way to the other. I think this statement reflects the fact that policymakers have, again, over extrapolated. And I wouldn't be surprised that in the next coming months, over the next 2 months, we're going to see inflation surprise actually on the downside, despite all the fear of policy disruptions on the downside, and that they will change their March projections and revise the statement to be more dovish once again later this year.
Okay, I definitely want to come back to that, but Allison, please, your reaction to the statement, and please do put it in Britney Spears song form as well.
I can't think of. I'm blanking on her song catalog, but I did find it also vague. It is more interesting, but it pretty much is just like, yeah, inflation's still too high, but the market's kind of not slowing down, so we're just gonna sit here for a while, which is vague but descriptive.
Right.
So I said pretty much what you get. I said it has felt like for at least the last year that inflation is not trending down the way it was before, and so I think it's only their concern that inflation could reignite later in the year, but that like sort of the disinflationary pressures just aren't there anymore. And they're never going to admit, they've never admitted that they don't make their target. Like for all that time they couldn't reach their target, they were kind of like, yeah, we're on our way up, and now they never were. And now they're sort of like hovering just above their target, and they're sort of, I said, being vague. Because once they admit they can't make their target, this whole ruse of inflation targeting kind of goes away. And where are we then? This is like the whole philosophy of monetary economics now.
Yeah, but at the same time here, let me play the role of the dove, and Greg, I'd take any help I could get against an intellectual force like Allison here. But inflation comes in many flavors, right? And if you're looking, I'm a 3-month annualized bro. That's how I characterize myself, right? If you look at more closer in readings, things are not too bad, and they haven't been, too bad for a while, especially if you focus on market-based measures, right? So my interpretation is that the general public, and to a certain extent, the monetary policy community, overweights the year-on-year measures, and there is a strong possibility, it's not definite, but there's a strong possibility that we could see those year-on-year measures really coming in pretty quickly, I think, as we get into February, March, April, just because of the base effects. And I wonder, could that really change the conversation? If I'm right, which is, I know a big if, but if we don't get, for instance, like a big January effect here, as we have gotten in years past, admittedly, and we do start to see those year-on-year numbers coming down, and maybe we're not back to 2%, but we're talking about on core PCE maybe a 2.4. We're in the bottom half of the twos. Does the conversation start to change in a meaningful way?
I think so. If you look at fundamentals, they're still disinflationary. You still have consumer caution, especially families at the lower end of the income spectrum and lower to median end of the income spectrum. You still have an environment where pricing power isn't that strong. You still have an environment where businesses are controlling for wage pressures. They're not cutting wages, but they're limiting wage growth. You still have an environment where you have strong productivity growth. The US is exceptional in that regard. And you still have an environment where idiosyncratic factors on the inflation front, whether it's shelter cost or inflation cost, are seeing reduced inflationary pressures. Doesn't mean we're going into deflation. We're far from that. But you're still seeing this disinflationary momentum, and I think it will carry through over the first quarter, at least, of the year, and perhaps into the spring. And to your point, yes, base effects will add to that, and you'll see that favorable comparisons relative to the start of last year, which was a little bit hotter than we had anticipated, will help push inflation closer to the Fed target. So I'm not too concerned about that. What I am concerned about is the risk of these sudden pivots in policy communication, because policymakers are too focused on this 2% target. And to tie into what Allison was saying earlier, there's nothing magical about 2% inflation. If we're trending at 2.3, in my opinion, that's fine. It doesn't affect how people behave. Yes, prices are still elevated, but that's not what the Fed controls. The Fed controls inflation, the price, the pace at which prices move. And if there's one lesson to be learned from the pre-COVID period, is that we were arguing about inflation being at 1.7, 1.8 relative to the 2% target. In my opinion, who cares? It doesn't really matter as long as you're within that range around 2%. That should be satisfactory from the Fed perspective.
Yeah, we were getting into a little bit some of the conversation around where's neutral. How do we distinguish the short-term neutral from the long-term neutral? But do you see a world, Greg, in which we're converging on a at least a short-term neutral with inflation still slightly above the target? Would the committee should they get comfortable with something like that? Should they just learn to live with 2.3s, 2.4s on core PCE in the near term?
Should they and will they? The should they, in my opinion, is yes, open for discussion. And I think the framework review that's starting now is a good opportunity to think about potentially having a range around that 2% target. Will they? No, they're not going to say that they're okay with 2.4% inflation. They want to get back to 2%, which is their target, mandated target, or actually decided target as part of the price stability mandate. And they're going to be focused on getting back to that. My opinion, that's too much of a laser focus, a bullseye focus on getting to 2%, which risks having excessively tight monetary policy when you could actually be thinking about loosening monetary policy. The context within which all of this is happening is a very delicate complex, right? It's an environment where you have inflationary risks from most policy proposals that have been put on the table from the administration. The growth effects are uncertain of tariffs and of tax cuts and of deregulation and immigration restraints, but the inflation effects are likely to be the upside. And that's, I think, part of the positioning that we're seeing. It's not explicit because policymakers want to be very careful not to play the political game. But I think what we're seeing, even in the statement to some extent, is this underpinning of an environment where we know inflation is going to be pressured up past the spring and into the next year. And that is one reason to stay a little bit cautious on the side of not easing too much.
Right. Yeah. To your point, in the summary of economic projections, if you sort of leafed through to the latter pages, you could see that members of the Federal Open Market Committee who submitted their estimates described a great deal of uncertainty around their estimates for inflation, and I think that is really reflecting uncertainty about what is going to happen with policy. But I want to sort of go through some of the policy proposals one by one here. Allison, you and I have talked a lot about tariffs, and this has been in the macro conversation really since Donald Trump took a lead in the presidential election. I want to ask you if you've learned anything new that has changed your view on tariffs from the fact that we are now, 10 days into the new administration. There's been a lot of bluster, but so far, which is maybe not to say much, it's only 10 days, but so far that bluster hasn't led to anything.
Although apparently we're 25% tariffs are coming on February 1st, and that's soon. It's a couple days.
Are you referencing his threat towards Canada and Mexico?
Yeah. I mean,
Right.
This could go down to
I was
the wire.
I was also told he was going to do tariffs on Colombia instantly.
That's true.
Right.
Yeah, I mean, I think this has been the question going into this administration of, is he serious about these tariffs or is it a negotiation ploy?
Right.
I guess we'll find out. But even if they are a negotiation ploy, I mean, it's different. It's a different world order where there's just certainly less certainty around economic relationships, where economic relationships come second to political relationships. And there's an argument to be made for that. But the thing is about uncertainty is that increases term premiums. So no matter what the Fed does, like we're definitely going to can expect steeper yield curves, certainly a higher 10-year rate. And also, potentially, dusting off my old like inflation models from grad school, more uncertainty about prices also feeds into more sort of less predictable pricing relationships, which can also increase inflation.
Yeah. Let me bring in a question from an Instagram user watching us out there. A question says, all right, we're talking about tariffs here. How do we think Powell will address his role of predicting tariff impacts versus reacting to them? Greg, you want to take a stab at that?
Yeah, the Fed is going to be highly reactionary going forward. There's no other way than for policymakers to be reactionary, because they don't want to take any political stance in the current environment, and they don't want to be seen as influencing or being influenced by political decisions. They want to stay independent and focused on their two mandates. So they're going to be extremely data dependent, extremely reactionary, perhaps a little late if they are too reactionary to potential inflationary pressures. But to tie this question back into what we were just talking about, tariffs, I don't think this is just a threat. I don't think this is just bluff. You can't bluff your way out of this environment. You at one point, there will be some tariffs that are imposed. It's just a matter of timing. My fear is that there is this dual objective on the one hand to try to raise revenues with tariffs, right? That's the stated objective by the administration. And on the other, to rebalance trade flows, to avoid trade deficits. Those are not, they don't work in unison. One does not work with the other. So there's going to be the internal pressure there between these two objectives. And then the other point to keep in mind is that when you have tariffs that are imposed, even though the administration and incoming Treasury Secretary Bessent have talked about avoiding the inflationary pressures by being gradual, if anything, a gradual approach to tariffs where you do 3% or 5% per month is actually going to lead to more lingering inflationary pressures, because every single month you're incrementing prices by another 5%. And there is that uncertainty as to, is it coming? Is it not coming? Which adds to what Allison was saying about, it feeds inflation. That uncertainty itself feeds inflation.
Right. Allison, let's go to some of the other Trump policy agendas here. So let's go to fiscal next, right? So obviously something is going to happen in the latter part of the year with the Tax Cuts and Jobs Act, President Trump's sort of signature policy achievement in his first presidency. You have these expiring provisions that need to be extended, and I think there's some assumption that that is going to happen. But on top of that, you have a number of promises, maybe to cut corporate tax rates, at least for certain companies that I guess produce domestically or say the right things to the administration. There could be some additional individual tax cuts. There was sort of a potpourri of ideas that were thrown out there on the campaign, like there's no tax on tips and stuff. So as we're sitting here talking about inflation and Fed policy, how do you think Jerome Powell and his band of brothers are thinking about that?
Well, it certainly doesn't make his job easier because, I'm even like optimistic that, some of this stuff could be growth enhancing, but not enough to pay for the debt it's going to incur. So, like Sue said, more debt is another sort of pressure pushing up interest rates, which again makes his job even harder. It potentially even not only increases long-term rates, but it could also increase the neutral rate. So I can't imagine he's excited about this. I think that's why everyone likes to talk about the debt, but no one wants to do anything about it. But it's also certainly why he's going to bring it up. Also, if you recall, more than 20 years ago, we used to assume that growth came with higher inflation. So even best case scenario, he just says tomorrow, guess what? This inflation thing, the tariff thing, I never meant it. Like we're like I'm joining TPP, something crazy. So even if that went away and we just had a pure growth agenda, which I would love, it still could be inflationary just because it's just more growth. And that would, again, make his job harder.
Right.
And because we're also starting from a point that is highly unusual if you look back at the last 4 decades, right? We're coming out of a highly inflationary environment where businesses understood that they had more pricing power than in the past, and where there was a little bit of free riding, right? If your competitor was seeing these import price pressures, they would pass it on, and then even if you didn't have as many pressures, you would consider the possibility of doing so because the risk of losing volume, losing market share was much less great. So that is very important. The context within which these tariffs, these deregulation efforts, which could be growth stimulating, these tax cuts that could also stimulate growth, are coming against a context that's very different from a pricing power perspective and from the fact that the economy is close to its potential. The economy has been growing at a 3% pace for the last 2 years. That gives you a sort of indication of where we are as a starting point. And that is why I was saying earlier that while the growth effect of the policy mix is uncertain, the inflationary effects are likely to be to the upside.
Yeah. Okay, so let's go to the last of the major items. I'll probably leave deregulation aside due to time constraints, but the last piece of the potentially inflationary policies, I think, is obviously immigration, because we've been through a period of tight labor markets. Maybe we're not quite as tight as we once were, but now you have this talk of not just restricting immigration flows, but potentially also deporting folks. In fact, we know that deportations are happening. It's become a major sort of media push of the Trump administration in these first couple of weeks. There is another question as to whether or not it's going to happen to a macroeconomically significant level. How are you thinking about all of that, Greg? As we see, a lot of these images on CNN and so forth, but we're sort of uncertain as to where the policy is ultimately leading.
Yeah, I'll start with where we are in terms of the economy and where we've been. We were in an economy that was recuperating from a massive shock, COVID, sudden stop to demand and supply. And fortunately, in the US in particular, we had this massive rebound in supply side dynamics. So you had fiscally stimulated growth on the supply front. You had supply chains that were recuperating. You had tremendous growth in labor supply and capital supply. All these elements allowed the US economy to grow at a 3% pace and actually see disinflationary pressures. So very strong supply side dynamics helping drive the potential of the economy higher. When you're asking about immigration, I think it's important to remember that the type of labor market that we have today, where we have a 4% unemployment rate, where we have labor force participation for prime age individuals that is near a 15-year high, those are very good conditions that are in part, or have been in part, supported by a rebound in immigration. And that's been helping drive the labor force, helping drive labor force participation. And that's been a solid underpinning to job growth, income growth, and in turn, consumer spending activity. If you start to weigh down on that element of the economy, then you're going to be constraining demand in the short run, but also supply in the long run. And that puts all the more pressure on driving stronger productivity if you want to maintain that high potential growth rate. So it is very important to keep a close eye on what's happening in terms of immigration. Our baseline assumption is that you see a net immigration decline from over 1 million to around 800,000 individuals per year. That in and of itself would reduce growth by 1/10 every year over the next decade. That's still a big hit. If you start to see deportations and reductions in workforce, that's going to put tremendous pressure on the economy, inflationary pressures on the sectors that are most reliant on immigrants, like non-authorized immigrants in the ag sector or in the construction sector, but also immigration across some of the high skilled sectors as well.
Well, I mean, doesn't it depend, though, on what the policy is? I mean, are we dependent on lots of undocumented migrants? I mean, right now, the deportations might not be that much higher than they were under even Obama. And if they're paired with an expansion on legal migration, and we do have a fairly significant program for, say, farm workers for stuff like that, then, I mean, potentially it could be better.
Could be better, but it is inflationary, and that's something that we have to keep in mind.
Well, but
Because
why? I mean, we could sort of take even more legal migrants. I don't know if that's on the table, but
yeah,
I mean,
but think of the ag sector as an example. There are mandated caps in terms of wages, or actually floors under wages for people that we bring into the U.S. for ag purposes. Those floors are generally higher than the prevailing wages that were in place, either for legal or unauthorized workers. So that puts upward pressure on the wage bills for farmers, and then in turn, those are passed on to consumers. So that tends to be inflationary. I'm all for an expansion of legal immigration, even people that come in to study, for instance. That's a good example whereby we shouldn't be limiting people that pay for their studies in the U.S. to be able to work and pay taxes. But that's a different question. I don't know that we're necessarily going to see that, but that would be a great avenue to drive stronger productivity growth, especially given the potential returns on productivity and on income growth.
Yeah, but to your key point there, Allison, as with tariffs and so much here, it depends on what the policy actually is, right? And it seems to me that there's also just an economic cost and maybe an inflationary cost of the uncertainty that we're living with here in 2025. Greg, do you agree with that? And do you think that it rises to the level of being macroeconomically significant, that cost?
I mean, there was a lot of pro-business sentiment right after the election. Going back to your initial question, on the day after the election, there was a lot of pro-business sentiment that was expected to drive stronger business investment, stronger deal-making activity. That was very favorable. I think if you look back at the last 72 hours, you've seen how volatile monetary policy can be in terms of potential threats of tariffs on Colombia over the weekend, to a freeze in financial aid that was later clarified as to what was being withheld. Those types of uncertain policy developments can also have a negative effect on economic activity on the private sector. And that's important to keep in mind when you're considering the whole environment in terms of the policy mix.
Yeah, I want to put the yield on our 2-year Treasury note back up on the screen just so folks can see where we are in terms of the market reaction. Now, we have, off of the back of this slightly hawkish statement, I believe those were your words, Greg, we have seen a yield on the 2-year Treasury note move up a little bit. We're around 4.25% from about 4.21% at the time that the statement hit. So, we've seen markets maybe a little bit unsettled by this. Allison, what would you like to hear from Jerome Powell here that could, further clarify things?
I mean, I don't know there's much you can say. I think my lack of clarity is just the world we're in. I think it's largely unknowable right now. So I guess all I could hear from him is a commitment to, which he'll probably do, to Fed independence and data dependence.
Yeah. Okay. Greg, I'll give you the last word. What are you looking to hear from Chair Powell?
Yeah, just a little bit more clarity on the direction of travel and the pace of expected travel. We're probably not going to get much, but I was just looking at the pricing of Fed rate cuts for this year. They haven't really changed much. I mean, the 5 basis points there don't seem to do much.
All right. Well, I want to thank everyone for tuning in. We'll let you all go so you can watch Jerome Powell's press conference. My name is Jonathan Levin. I'm a columnist with Bloomberg Opinion. You can find all of our work at bloomberg.com/opinion. Thank you to my colleague, Allison Schrager, and thank you to EY's Greg Dacko for joining us today. Have a great afternoon.
Thank you.